In 1842, the British Empire forced China to sign the Treaty of Nanking at gunpoint. The terms were humiliating. China had to pay massive war reparations in silver, open its ports to foreign trade, and hand over Hong Kong for the next 150 years. It was the beginning of what the Chinese call their century of humiliation. Foreign powers carved up their country like a cake, extracting wealth and imposing their will through military superiority and financial manipulation. Fast forward to today, and the tables have turned in the most ironic way imaginable. China now holds over $850 billion in United States Treasury bonds. They are one of America's largest creditors. The country that was once bankrupted and humiliated by Western powers now effectively lends money to the most powerful nation on earth. This is not just an economic story. This is a tale of historical revenge, strategic brilliance, and a fundamental shift in global power that most people do not fully understand. The story of how China came to own a massive chunk of American debt begins not in Beijing, but in Washington. And it starts with a decision that seemed brilliant at the time, but would eventually put America in a position it never imagined possible. To understand this reversal of fortune, we need to go back to 1971, to a moment that changed the entire global financial system. Before 1971, the world operated under something called the Bretton Woods system. This was an agreement made at the end of World War II. The idea was simple. Every major currency would be pegged to the US dollar, and the US dollar would be backed by gold. For every $35 in circulation, the US government promised it had 1 ounce of gold sitting in a vault somewhere. This gave the dollar credibility. It was not just paper, it was as good as gold. But there was a problem. Throughout the 1960s, America was spending money it did not have. The Vietnam War was draining the Treasury. Social programs under President Johnson's Great Society were expensive. The government was printing more dollars than it had gold to back them up. Other countries started to notice. They started showing up at America's door, asking to exchange their dollars for the gold they were promised. France was particularly aggressive about this. President Charles de Gaulle did not trust the dollar. He did not like that America could essentially print money to pay its bills while other countries had to balance their budgets. So France started sending ships to New York Harbor to collect gold. Other countries began doing the same. America's gold reserves were being drained, and the whole system was on the verge of collapse. On August 15, 1971, President Richard Nixon went on television and made an announcement that would change everything. He said the United States would no longer convert dollars to gold. Just like that, he ended the gold standard. It was supposed to be temporary, but it became permanent. The dollar was no longer backed by anything except the full faith and credit of the US government. It was now what economists call a fiat currency. Its value came from the fact that people believed in it and that you could use it to pay taxes. This decision gave America an incredible power. It could now print as much money as it wanted without worrying about gold reserves, but it also created a new problem. If the dollar was not backed by gold, how would America convince other countries to keep using it? How would it convince them to keep accepting dollars in exchange for real goods like oil, electronics, and manufactured products? The answer came from an unlikely place: Saudi Arabia and the other oil-rich nations of the Middle East. In 1974, the United States made a deal with Saudi Arabia. America would provide military protection and weapons. In exchange, Saudi Arabia would sell its oil only in US dollars and invest its surplus oil revenues in US Treasury bonds. This was the birth of the petrodollar system. Suddenly, every country in the world needed dollars. If you wanted to buy oil, which every industrialized nation did, you needed US dollars. This created automatic demand for the currency. And what did oil-producing countries do with all those dollars they earned? They bought US Treasury bonds. They were essentially lending their money back to America. This system was genius. America could import oil and other goods, pay with dollars it could print, and then those same dollars would come back to America in the form of loans. It was the closest thing to a perpetual motion machine the financial world had ever seen. The US was not just the world's largest economy. It was the center of the entire global financial system. But this system had a vulnerability that nobody fully appreciated at the time. It required other countries to keep buying US debt. America was becoming dependent on foreign creditors, and as long as those creditors were allies like Britain, Japan, and Saudi Arabia, that seemed fine. But what if a rival nation figured out how to use the system against America? Enter China. In the late 1970s, China was poor, desperately poor. Decades of communist economic policies under Mao Zedong had left the country impoverished and isolated. The average Chinese citizen earned less than $200 per year. But in 1978, a new leader named Deng Xiaoping came to power with a radically different vision. He famously said, "I do not care if a cat is black or white, as long as it catches mice." In other words, he did not care about communist ideology. He cared about results. He cared about making China rich. Deng opened up China to foreign investment and trade. He created special economic zones where capitalist-style businesses could operate. He encouraged Chinese companies to manufacture goods for export, and he did something that would prove to be strategically brilliant. He kept the Chinese yuan artificially cheap compared to the dollar. Here's how that worked. When Chinese companies exported goods to America, they got paid in dollars. But Deng's government did not let those dollars float freely in the market. Instead, the Chinese central bank bought up those dollars and gave the Chinese companies yuan in exchange. This did two things. First, it kept the yuan weak, which made Chinese exports cheaper and more competitive in global markets. Second, it gave China an enormous pile of US dollars that needed to be invested somewhere. And where did China invest those dollars? In US Treasury bonds. By the mid-1980s, China was starting to become a significant holder of American debt, but nobody was worried about it yet. China was still poor. It was still a developing country. The amounts were relatively small. American policymakers actually saw this as a good thing. Chinese money was helping to finance the US government at low interest rates. But China was playing a much longer game than anyone realized. Every year, the trade imbalance between the United States and China grew larger. American consumers loved cheap Chinese products. Walmart and other retailers filled their shelves with Chinese-made goods. Everything from toys to electronics to furniture was increasingly made in China. American manufacturing jobs were disappearing, but American consumers were saving money and enjoying a higher standard of living. The U.S. trade deficit with China exploded. In 1985, it was just $6 million. By 1990, it had grown to $10 billion. By 2000, it was $83 billion. By 2010, it had reached an astounding $273 billion. Every year, America was buying far more from China than China was buying from America. And every year, those surplus dollars flowed back to China. China took those dollars and bought more and more U.S. Treasury bonds. They were lending America the money to buy Chinese products. Think about how circular this system had become. Americans bought Chinese goods with money they often did not have, borrowing through credit cards and home equity loans. The U.S. government ran massive budget deficits, spending far more than it collected in taxes. To finance these deficits, the Treasury issued bonds. China bought those bonds with the dollars they earned from selling products to America. Then, America used that borrowed money to buy more Chinese products. It was a cycle that seemed like it could go on forever. By 2008, China held over $600 billion in U.S. Treasury bonds. They had become America's banker. But most Americans did not realize what this meant. They did not understand that every time they bought a cheap television or a pair of sneakers made in China, they were participating in a system that was fundamentally shifting global power. Then came the financial crisis of 2008, and everything nearly fell apart. The crisis started in the United States with the collapse of the housing market and the failure of major financial institutions. Suddenly, the entire global economy was in free fall. Stock markets crashed, banks failed, millions of people lost their jobs. The U.S. government had to bail out major banks and corporations to prevent a complete economic collapse. To do this, America needed to borrow even more money. The Treasury started issuing bonds at an unprecedented rate. They needed creditors willing to buy those bonds. And who stepped up? China. During the darkest days of the financial crisis, when faith in the American financial system was at its lowest, China kept buying U.S. Treasury bonds. Some people saw this as a vote of confidence in America. But China had a different motive. They were not buying bonds because they believed in America. They were buying bonds because they were trapped. Here is the trap. China had over $1 trillion in U.S. currency reserves by this point. If the U.S. economy collapsed, those dollars would become worthless. China had no choice but to prop up the American economy to protect its own assets. It was like a creditor lending more money to a failing business because if the business goes bankrupt, the creditor loses everything they have already lent. China was pot committed, as poker players say, but China also started to understand the strategic implications of this position. They held enough U.S. debt that if they suddenly decided to sell it all, they could trigger a financial catastrophe in America. U.S. interest rates would spike. The stock market would crash. The dollar would plummet. China had what amounted to a financial nuclear weapon. American politicians began to wake up to this reality. There were congressional hearings. Think tanks published reports with alarming titles. The media ran stories about how China owned America. In 2011, China's holdings of U.S. Treasury bonds peaked at over $1.3 trillion. That is trillion with a T. To put that in perspective, if China was a U.S. state, its holdings of Treasury bonds would make it wealthier than all but a handful of states. Some Americans panicked. There were fears that China would use this debt as leverage to force political concessions. What if China threatened to dump U.S. bonds unless America stopped supporting Taiwan? What if they demanded that America remove its military bases from Asia? What if they used their creditor status to bend U.S. foreign policy to their will? But here is where the story gets more complicated. China never really had as much leverage as people feared. Yes, they could sell US Treasury bonds, but doing so would hurt China almost as much as it would hurt America. If China dumped their bonds, the value of those bonds would collapse. China would take massive losses on their investment. The dollar would weaken, which would make Chinese exports to America more expensive and less competitive. Chinese factories would lose orders. Workers would lose jobs. It would cause chaos in China's economy. This is what economists call mutually assured destruction in financial form. Both countries were locked together in an economic embrace where neither could afford to let go without hurting themselves. It was like two people holding each other over a cliff. If either one lets go, both fall. But even though China could not weaponize the debt the way some feared, the situation still represented a dramatic shift in global power. For the first time in modern history, the United States was deeply indebted to a geopolitical rival. China might not be able to use the debt as a direct weapon, but the relationship had fundamentally changed. America was no longer the undisputed financial hegemon it had been for decades. China knew this, and they started to take steps to reduce their vulnerability and increase their options. In the years after the financial crisis, China began slowly reducing its holdings of US Treasury bonds. They diversified into other assets. They bought gold. They made investments in infrastructure projects around the world through their Belt and Road Initiative. They started promoting the yuan as an alternative currency for international trade. China also learned from what America had done with the petrodollar. They started making deals with other countries to trade in yuan instead of dollars. They set up currency swap agreements. They pushed for the yuan to be included in the International Monetary Fund's basket of reserve currencies, which happened in 2016. China was systematically trying to reduce the world's dependence on the dollar and create alternatives. The numbers tell the story. In 2013, China held $1.3 trillion in US Treasury bonds. By 2023, that number had dropped to around $850 billion. They are still one of the largest foreign holders of US debt, but the trend is clear. China is slowly extricating itself from this entanglement. They are looking for ways to have influence without being exposed to the risk of American economic instability. Meanwhile, America's total national debt kept growing. In 2008, it was $10 trillion. By 2023, it had exploded to over $33 trillion. The United States now borrows more than $1 trillion every year just to pay for its current spending. Interest payments on the debt now consume a larger and larger share of the federal budget. America is not just borrowing from China anymore. It is borrowing from anyone who will lend, including from itself through the Federal Reserve. But here is what most people miss when they talk about China owning American debt. The real story is not about who holds the bonds. The real story is about how this situation came to be and what it reveals about the relationship between these two countries. It is a story about short-term thinking versus long-term planning, about consumption versus production, about strategic patience versus immediate gratification. For decades, American policy has been dominated by short-term concerns. Politicians focus on the next election cycle. Consumers focus on buying things now and worrying about payment later. The government cuts taxes and increases spending simultaneously, borrowing to make up the difference. This is politically popular because everyone gets what they want immediately, but it builds up long-term vulnerabilities. China, on the other hand, has played a patient game. They were willing to keep their people poor for longer to build up industrial capacity. They were willing to accept lower returns on their investments to gain strategic positioning. They thought in terms of decades, not years. While America was focused on winning the Cold War and then enjoying the peace dividend, China was quietly building the foundations of economic power. The irony is almost too perfect. America defeated the Soviet Union in the Cold War partly through economic means. The US outspent the Soviets on defense, forcing them to allocate more and more of their economy to the military until their system collapsed under the weight. America proved that economic power matters more than military power. And then, having learned this lesson, America turned around and allowed another potential rival to become its creditor. Some economists argue that this is not really a problem. They point out that the US borrows in its own currency. Unlike countries that borrow in foreign currencies, America can always pay its debts by printing more dollars. The Federal Reserve can always buy Treasury bonds if no one else will. From this perspective, worrying about who holds U.S. debt is missing the point. The real question is whether America is investing borrowed money wisely or wasting it. And that is where the story becomes uncomfortable for many Americans. Much of the money that America borrowed went not into productive investments, but into consumption. It financed tax cuts that disproportionately benefited the wealthy. It paid for wars in Iraq and Afghanistan that cost trillions of dollars and achieved questionable results. It sustained a level of consumer spending that required importing more and more goods from abroad. Meanwhile, infrastructure crumbled, education outcomes stagnated, and income inequality grew. China, by contrast, used its accumulated wealth to build. They constructed high-speed rail networks that crisscrossed the country. They built modern cities from scratch. They invested heavily in technology and education. They created a manufacturing base that now produces nearly 30% of global manufacturing output. They turned their dollar reserves into tangible assets and capabilities. The question is not whether China can use its holdings of U.S. debt as a weapon. The question is whether America is using its ability to borrow so cheaply as a tool to build long-term prosperity or as a way to avoid making hard choices. So far, the evidence suggests the latter. But there's another dimension to this story that often gets overlooked. The relationship between China and America, between creditor and debtor, is not just economic. It has profound political and military implications. Throughout history, debtor nations have often found themselves constrained in their foreign policy. They cannot afford to antagonize their creditors too much. They have to consider the financial consequences of their actions. Does America's debt to China constrain U.S. foreign policy? It is hard to say definitively, but there are hints. America has been much more cautious about defending Taiwan than many hawks would like. Trade policies toward China have been inconsistent, with tough talk often not backed up by tough action. Even during the Trump administration, which took a harder line on China than previous governments, there were limits to how far things went. Of course, America also has leverage. The U.S. military is still far more powerful than China's. America has alliances around the world that China lacks. The dollar is still the dominant reserve currency. American universities, technology companies, and financial institutions are still the envy of the world. Power is multidimensional, and America still has many advantages. But the debt relationship is a complicating factor. It is one more thing American policymakers have to consider, one more constraint on action. And the fact that it exists at all represents a dramatic change from the post-World War II era, when America was the world's largest creditor nation. There's also a generational aspect to this story. The Americans who created the system that led to China buying U.S. debt are mostly retired or dead now. They are not the ones who will live with the consequences. The young people growing up today are inheriting a country with massive debts, aging infrastructure, and a complex relationship with a rising China. They did not make the decisions that created this situation, but they will have to deal with it. Some people argue that this is all just inevitable, that China's rise and America's relative decline are simply the result of economic fundamentals. China has 4 times as many people as America. It is natural that as they develop, their economy would eventually rival or even surpass America's. From this perspective, the debt relationship is just a reflection of these underlying realities. But others argue that nothing was inevitable, that America made specific policy choices that accelerated these trends. The decision to allow China into the World Trade Organization in 2001 without demanding that they adopt market-based currency policies. The decision to run massive budget deficits year after year. The decision to prioritize financial engineering over manufacturing. The decision to let Wall Street grow more powerful while Main Street hollowed out. These were choices, not inevitabilities. And now America faces new choices. Does it try to reduce its dependence on Chinese manufacturing, even if that means higher prices for consumers? Does it get serious about reducing the budget deficit, even if that means cutting popular programs or raising taxes? Does it invest heavily in education, infrastructure, and technology to rebuild its competitive advantages? Or does it continue on the current path, hoping that somehow everything will work out? China faces choices too. They have their own economic problems. Their population is aging rapidly due to decades of the one-child policy. They have massive amounts of debt themselves, much of it in questionable real estate investments. Their political system, while effective at some things, lacks the flexibility and freedom that has made America so innovative. The question is whether China can continue its rise, or whether they will hit their own limits. What is clear is that the relationship between these two countries will define much of the 21st century. And at the center of that relationship is this strange financial entanglement. America depends on China to buy its debt and finance its deficits. China depends on America to buy its products and provide markets for its factories. Neither can afford to let the other fail, but neither fully trusts the other. This is not how America imagined things would turn out back in 1971 when Nixon ended the gold standard. The vision then was that American financial dominance would be eternal, that the dollar would reign supreme, that America would always be the lender, never the borrower. But history has a way of surprising us. Systems that seem permanent eventually change. Powers that seem invincible eventually decline. The Chinese remember their century of humiliation. They remember being forced to accept unequal treaties. They remember foreign powers dictating terms. And now they find themselves in a position where they hold hundreds of billions of dollars in debt from the country that was once their main rival. They did not achieve this through war. They did it through patient economic strategy and by taking advantage of a system that America itself created. Does this mean China has won and America has lost? Not necessarily. The story is still being written. Economic power is not zero-sum. Both countries can prosper or both can struggle. The debt relationship is just one factor among many, but it is a factor that would have seemed impossible 50 years ago, and it is a factor that will influence events for decades to come. The deeper lesson here is about the nature of power itself. Military power is important, but it is not everything. Cultural power matters, but it has limits. Economic power, the ability to produce goods, to accumulate wealth, to lend and borrow, this is a form of power that shapes everything else. And economic power can shift much faster than most people realize. In the 19th century, Britain was the world's workshop and the world's banker. By the mid-20th century, America had taken that role. And now, in the early 21st century, China has become the world's workshop and one of the world's major creditors. These shifts happen over generations, so slowly that people living through them often do not notice. But when you step back and look at the big picture, the changes are dramatic. The question for America is whether this is a temporary setback or permanent decline. Can America reinvent itself as it has done before? Can it address its fiscal problems, rebuild its manufacturing base, and maintain its innovative edge? Or has it locked itself into a pattern of decline, borrowing more and more to maintain a standard of living it can no longer afford? The question for China is whether it can continue rising without triggering a backlash. Can it accumulate more wealth and power without provoking conflict? Can it manage its own internal challenges, from demographics to debt to political repression? Or will it overreach, as rising powers so often do, and provoke a coalition that limits its ambitions? These are the questions that will shape the coming decades. And at the center of it all is this strange financial relationship, where America borrows and China lends, where the world's largest economy is indebted to its greatest rival, where the tables have turned in ways that would have seemed impossible just a generation ago. History is full of reversals like this. The Persians once ruled the known world. Then they were conquered by the Greeks. The Romans built an empire. Then they were overrun by barbarians. The Spanish had the most powerful fleet on earth. Then it was destroyed by storms and English raids. The British ruled a quarter of the globe. Then they were bankrupted by 2 world wars. Power is never permanent. Empires rise and fall. The question is not whether things will change, but how and when and at what cost. For now, America and China remain locked in their economic embrace. China cannot afford to let America fail because they have too much invested in U.S. debt. America cannot afford to antagonize China too much because they need China to keep buying that debt. It is a strange kind of peace, based not on trust or shared values, but on mutual vulnerability. Each side is holding a gun to the other's head, and both know that pulling the trigger means their own destruction as well. This is the reality of the modern world. The neat divisions of the Cold War, where you were either with America or against it, no longer apply. The global economy is too interconnected. Supply chains cross borders. Investments flow in every direction. Your rival is also your customer and your creditor. It is messy and complicated and full of contradictions. And somewhere in Beijing, Chinese officials look at their holdings of U.S. Treasury bonds and remember the Treaty of Nanking. They remember the foreign concessions in Shanghai. They remember the humiliation of being carved up by foreign powers. And they understand that this is not just about money. This is about dignity. This is about taking their place at the center of world affairs. This is about reversing 200 years of history. Whether they can do it, whether America can prevent it, whether the two countries can find a way to coexist without catastrophic conflict, these are the great questions of our time. And the answer will be written not in military battles or diplomatic summits, but in balance sheets and trade flows and interest payments on trillions of dollars in debt. The Chinese are patient. They are playing for the long game. They were willing to be poor for decades to get rich later. They were willing to lend money at low rates to gain strategic position. They were willing to absorb pollution and labor exploitation to build industrial capacity. Now they are reaping the rewards of that patience. America, for its part, has been impatient, focused on the next quarter, the next election, the next immediate gratification, borrowing from the future to pay for the present, living beyond its means and assuming that somehow it would always work out because it always had before. But history does not repeat, and trends that seem permanent can reverse suddenly. So here we are in 2026, with China holding hundreds of billions in U.S. debt, with America borrowing trillions more every year, with both countries circling each other warily, each dependent on the other, each planning for advantage, each hoping to avoid catastrophe. This is not how the story of American dominance was supposed to end. But then again, empires never plan for their own decline. They always think they are the exception, that the rules of history do not apply to them. Rome thought that, Britain thought that. And now America might be learning that same hard lesson. The mechanics of how this system actually works are worth understanding in more detail because they reveal just how deeply interconnected these two economies have become. When an American walks into a Walmart and buys a television made in China for $300, that transaction starts a chain reaction that circles the globe. The Chinese factory that made the television gets paid in yuan by the Chinese exporter, but the American retailer paid for it in dollars. So somewhere in between, those dollars need to be converted to yuan. This happens through the Chinese banking system. The Chinese exporter takes their dollars to a Chinese bank. The bank gives them yuan in exchange, but the bank does not want to hold dollars. So they sell those dollars to the People's Bank of China, which is China's central bank. Now, the People's Bank of China has a pile of dollars. What do they do with them? They cannot spend them in China. Chinese workers and suppliers want to be paid in yuan, not dollars. So the central bank needs to invest those dollars somewhere. And the safest, most liquid investment in dollars is U.S. Treasury bonds. So the People's Bank of China buys Treasury bonds from the U.S. government. This is essentially a loan. China is lending money to the U.S. government. The U.S. government takes that money and spends it on everything from military equipment to social security payments to infrastructure projects. And then some of that money flows back to American consumers, who use it to buy more Chinese products, which generates more dollars that flow to China, which China uses to buy more treasury bonds. It is a circle, a loop that feeds itself. And as long as both sides benefit from it, the loop continues. Americans get cheap consumer goods and can maintain a higher standard of living than their incomes alone would support. The U.S. government can run deficits without facing immediate fiscal consequences because China is willing to lend at low interest rates. Chinese factories get orders that employ millions of workers. The Chinese government accumulates dollar reserves that give it financial security and international influence. But this loop also creates dependencies and vulnerabilities on both sides. America becomes dependent on Chinese manufacturing and Chinese lending. If China stopped making products for American markets, prices would rise dramatically and shortages would appear. If China stopped buying treasury bonds, the U.S. government would have to either cut spending, raise taxes, or pay much higher interest rates to attract other lenders. China becomes dependent on the American market and the stability of the dollar. If Americans stopped buying Chinese products, millions of Chinese workers would lose their jobs and social unrest could follow. If the dollar collapsed in value, China's vast reserves of dollar-denominated assets would be worth much less. China cannot easily dump its treasury holdings without crashing the value of the very assets it is trying to sell. This mutual dependency is often compared to the nuclear standoff during the Cold War. Neither side can attack without suffering catastrophic damage themselves. But unlike nuclear weapons, which hopefully will never be used, the economic relationship between America and China is active every single day. Trillions of dollars in trade flows back and forth. Every transaction either strengthens or weakens the bonds between these two rivals. What makes this situation particularly interesting is how it has evolved over time. In the 1980s and 1990s, when China first started accumulating large amounts of dollars, American policymakers saw it as a good thing. China was helping to keep American interest rates low. Chinese savings were financing American consumption and government spending. It seemed like a win-win situation. Some economists even argued that this arrangement could go on indefinitely. They called it Bretton Woods II, a reference to the post-World War II monetary system. The idea was that just as European countries had once supported the dollar by holding dollar reserves, now Asian countries, led by China, were doing the same thing. America would run trade deficits and fiscal deficits, and Asian countries would finance those deficits by buying treasury bonds. Everyone would benefit from global trade and growth. But this rosy view started to crack during the 2000s. Some economists began warning that the imbalances were unsustainable. America was consuming far more than it was producing. The trade deficit was growing larger every year. The government debt was ballooning. At some point, these trends would have to reverse, and the adjustment would be painful. The financial crisis of 2008 seemed to prove the skeptics right. The crisis exposed fundamental weaknesses in the American economy. Too much debt, too much speculation, too little productive investment. When the housing bubble burst and the financial system nearly collapsed, many people thought this would be the moment when China and other creditors lost faith in America and stopped buying treasury bonds. But that is not what happened. Instead, China doubled down. In 2008 and 2009, China actually increased its purchases of U.S. Treasury bonds. Why? Because they understood that if America went down, they would go down too. Their economy was deeply integrated with America's. A depression in America would mean a depression in China. So China helped bail out America, not out of charity, but out of self-interest. This created a strange dynamic. America needed China's money, but China also needed America's market and the stability of the dollar. Neither side had the upper hand. Neither side could walk away. They were locked together in what some analysts called a financial marriage, one where both partners were somewhat unhappy, but neither could afford a divorce. After the crisis, things started to change slowly. China began to realize that holding so much U.S. debt was a vulnerability. They were too exposed to American economic policy. If the Federal Reserve decided to print massive amounts of money, which it did through quantitative easing, the value of China's dollar holdings would be eroded by inflation. If American politicians decided to default on the debt or restructure it, which some Tea Party politicians threatened to do, China would suffer huge losses. So China started diversifying. They reduced their treasury holdings as a percentage of their total reserves. They bought more gold. They made loans to other countries through development banks and the Belt and Road Initiative. They started promoting the yuan as an alternative currency for international trade. These moves were gradual and careful because China did not want to trigger a panic or a backlash. But the direction was clear. China was slowly trying to reduce its dependence on the dollar and on America. America, meanwhile, seemed oblivious to these long-term trends. Political dysfunction in Washington meant that addressing the fiscal situation was nearly impossible. Any proposal to cut spending was attacked by those who would lose benefits. Any proposal to raise taxes was attacked by those who would pay more. The result was paralysis. The debt kept growing and the problem kept getting kicked down the road. The Trump administration brought a different approach. Trump recognized that China was a strategic competitor and that the economic relationship was unbalanced. He imposed tariffs on Chinese goods. He tried to force American companies to bring manufacturing back home. He accused China of manipulating its currency and stealing intellectual property. For the first time in decades, an American president was openly challenging the economic relationship with China. But the results were mixed. The tariffs did not significantly reduce the trade deficit. American consumers ended up paying higher prices for many goods. Some manufacturing did return to America, but much of it went to other low-cost countries like Vietnam and Mexico rather than creating American jobs. And China retaliated with its own tariffs, hurting American farmers and manufacturers who exported to China. The Biden administration continued some of Trump's tough policies on China while trying to repair relationships with allies. The focus shifted to things like semiconductors and technology, where America still has advantages. There was recognition that simply imposing tariffs was not enough. America needed to invest in its own competitiveness, in research and development, in education and infrastructure. But making those investments requires money, and America is already deeply in debt. This is the fundamental dilemma. To compete with China, America needs to invest heavily in the future. But it is already borrowing huge amounts just to finance current operations. Taking on even more debt creates more vulnerability to creditors, including China. Not investing means falling further behind. It is a difficult choice with no easy answers. Throughout all of this, the average American has largely been insulated from these macroeconomic trends. Yes, manufacturing jobs disappeared, but unemployment has generally remained low as service jobs replace them. Yes, the government runs huge deficits, but taxes have not increased dramatically for most people, and government services have not been cut significantly. Yes, China holds a lot of American debt, but interest rates have remained low and the dollar has remained strong. This disconnect between macroeconomic reality and individual experience is part of what makes this issue so hard to address politically. When things seem fine on the surface, it is difficult to convince people that fundamental changes are needed. Politicians who talk about fiscal responsibility and the dangers of debt are often ignored or voted out of office in favor of those who promise more benefits and lower taxes. But just because consequences have not arrived yet does not mean they never will. Throughout history, unsustainable economic situations have persisted for years or even decades before suddenly collapsing. The Soviet Union seemed stable until it was not. Japan's bubble economy seemed invincible until it popped. The Eurozone crisis caught many people by surprise, even though the underlying problems had been building for years. The question is not whether the current trajectory of American debt and Chinese lending is sustainable indefinitely. It clearly is not. The question is when and how it will change, and whether that change will be managed gradually or will come as a sudden crisis. There are several possible scenarios for how this could play out. In an optimistic scenario, America gets its fiscal house in order. It makes the hard choices to either cut spending or raise taxes, or both. It invests in education, infrastructure, and technology to rebuild its competitive advantages. The trade deficit with China shrinks as American manufacturing revives. China's economy continues to grow, but its growth rate slows as it faces its own demographic and economic challenges. The two countries remain rivals, but manage their relationship without catastrophic conflict. In a pessimistic scenario, America continues to run massive deficits until creditors lose faith. Interest rates spike as the government has to offer higher returns to attract lenders. This triggers a debt crisis. The government is forced to make drastic cuts to spending, causing a severe recession. The dollar loses its status as the world's reserve currency. China and other countries move to alternative systems. America's global influence declines sharply, and the world enters a period of instability as the old order breaks down, but no new order has taken its place. In between these extremes are many other possibilities. Perhaps America and China find a way to rebalance their relationship gradually. Perhaps technology changes the game in ways that no one predicts. Perhaps some external shock, a pandemic, a war, a climate catastrophe, forces both countries to cooperate in ways they otherwise would not. What is certain is that the current situation cannot continue indefinitely. Something has to give. Either America will reduce its deficits and its dependence on foreign lending, or those deficits will become so large that a crisis becomes inevitable. Either China will continue to hold large amounts of dollar assets, accepting the risks that come with that, or it will find alternatives that reduce its exposure to American policy decisions. The tragedy of this situation is that it was largely avoidable. America did not have to run such large fiscal deficits. It could have invested its borrowed money more wisely. It could have maintained its manufacturing base instead of letting it hollow out. It could have required China to play by market rules before admitting it to the global trading system. These were choices, and different choices would have led to different outcomes. But democracies, especially wealthy democracies, have a hard time making hard choices. Why cut spending or raise taxes today when you can borrow and push the costs into the future? Why invest in long-term competitiveness when that will not pay off until after the next election? Why confront a trading partner when consumers love cheap imports? The incentives all push toward short-term thinking and away from long-term planning. China, with its authoritarian system, does not face the same constraints. The government can make decisions without worrying about the next election. It can force people to accept lower living standards in the short term for long-term gain. It can direct investment towards strategic priorities without having to convince voters or negotiate with opposition parties. This gives China certain advantages, at least when it comes to long-term economic planning. But authoritarian systems have their own weaknesses. They are less flexible, less innovative, less able to adapt to changing circumstances. They often make massive mistakes because there are no checks on power. They can suppress dissent, but that dissent does not go away. It just builds up until it explodes. China's system has delivered extraordinary economic growth, but it is far from clear that it can continue to do so, or that the Chinese people will continue to accept one-party rule once they become wealthier and more educated. So both systems have strengths and weaknesses. Both countries face serious challenges. The question is which set of strengths and weaknesses will prove more important in the coming decades. Will America's flexibility and innovation overcome its political dysfunction and fiscal irresponsibility? Will China's strategic planning and state capacity overcome its lack of freedom and looming demographic crisis? The debt relationship between these two countries is just one piece of a much larger puzzle, but it is an important piece because it reveals so much about how both countries approach the world. For America, it reveals a country that has been living beyond its means, consuming more than it produces, borrowing from the future to pay for the present. For China, it reveals a country that has been patient and strategic, willing to accept less today for more tomorrow, accumulating power through economics rather than military force. In the end, this is a story about the nature of power in the modern world. Military power still matters, but economic power matters more. The country that can produce goods efficiently, that can accumulate capital, that can lend money to others, the country has enormous influence even if it never fires a shot. China understood this. They studied how America became powerful after World War II. They studied how Britain became powerful in the 19th century, and they applied those lessons with patience and discipline. America, having been on top for so long, forgot these lessons. It assumed that its dominance was natural and permanent. It assumed that it could borrow indefinitely without consequences. It assumed that economic strength would take care of itself while it focused on military power and political leadership. These assumptions are now being tested, and it is not clear they will hold. The next chapter of this story is being written right now in the decisions being made in Washington and Beijing, in the factories and trading floors and central banks, and the choices of billions of ordinary people who just want a better life for themselves and their children. The debt is real, the numbers do not lie, but what those numbers mean for the future, that is still being determined. And that is what makes this moment in history so fascinating and so dangerous and so full of possibility. This is John from Cinematic History Tales. Hit subscribe now because the next chapter of this story is being written as we speak, and you don't want to miss what comes next. While others are distracted by headlines, you'll understand the forces really shaping our world. See you in the next one.